in today's Crypto Caffeine, let's talk about some of the recent market updates. For one, positive vibes, short squeezes, and a magical golden cross have led Bitcoin to reach new highs for 2019. Only 14,000 more until we reach the previous all-time high. Second, Fidelity will offer cryptocurrency trading within a few weeks. The firm said in October that it would offer OTC trade execution and order routing for Bitcoin early this year, but only to accredited investors. So basically no different than previous competitors like Goldman Sachs. I'll wait for them to actually launch before I make my judgment, because we've seen delays of platforms like Bakkt and ErisX, which are arguably bringing more to the table. That said, every little bit helps. Finally, for the last piece of news, apparently regulators are ready to approve Ethereum Futures, according to CoinDesk and a CFTC insider. This subsequently led Ethereum to jump double digits. But unfortunately, the headline is a bit misleading. Basically, the source is saying that if they receive a valid application, then there's a chance that they would approve it. However, it doesn't sound like they've received any such application. Essentially, it boils down to one more baby step in the right direction, but nothing to get too excited about just yet. But while I'm not counting on a surprise bull market, I do see the pieces aligning in ways we've been waiting for. Remember that only a few weeks after we saw the last Bitcoin golden cross in 2015, we saw a death cross right afterwards. And yet, hindsight would have told you that 2015 was an awesome time to be getting into Bitcoin and this new thing called Ethereum. So yes, 2019 is a different market, a different ecosystem, and a different space overall versus 2015, but the central tenets are still at play. And to capitalize on that, Doc is going to be teaching his new small accounts trading class starting tomorrow, which focuses on trading and maintaining a small account, and hopefully surviving and eventually thriving in a bull market. So definitely look forward to that live stream. As a tangent to that, I've linked a video in the description where Ray Dalio, a well-known billionaire investor and hedge fund manager, describes his holy grail in portfolio allocation, nailing the sweet spot between diversification and correlation. And I really don't think he does a good job of explaining it, but the basic premise is sound and you should be aware of that. Essentially, have a portfolio of uncorrelated assets with strong returns, and it will yield you a better return to risk ratio. That is the holy grail. Now, related to the crypto space, I've also linked a crypto asset correlation analysis by a guy named Vivek, which looks at the correlation trends over the last year in the crypto market. Both of these sources are pretty dense, but I'll explain why they're very interesting and you should be aware of what they're talking about. Vivek's article is definitely pretty dense and data heavy, but what we can really glean from it is how, in a bear market, crypto assets tend to essentially circle the wagons and tighten the correlation matrix values. We can see that as we move from a bull market in January of 2018 to a full-blown bear by that May. Remember how in the bull market, the market was rather individualistic. It was a bettor's game. For those who are part of that bull market, you probably remember how seemingly every week there was a new hot coin that demanded attention. One week it was EOS, the next it was Ripple, the next it was Neo. It was exciting because it played a lot like a casino. And notably, that was also correlated with a drop in BTC market dominance. And then the inverse was true once we were in the grips of the bear. BTC dominance rose, no more individualistic breakouts, but a solid block of red. That continued until around the time we were getting over the delusional state of the Bitcoin ETF mania in late August and September. But unfortunately, the market reverted in October and November, and it became tightly correlated again as we went through another vicious bear cycle. But now, as we've seen, things are starting to warm up again. You have large caps making breakouts, and this is reinforced by the data as the correlation matrix is trending once again to a true state of decoupling. So the big question here, can correlations be used as a market indicator? Maybe. Dating back to 2016, when most of the altcoin market really emerged, correlation movements coincided with bull and bear market trends. Market reversals are typically met with upward or downward spikes in correlation between crypto assets and Bitcoin. The majority of crypto assets generally reach levels of little to no correlation with Bitcoin during market rallies. The historical data shows that bear market reversals are typically followed by a sharp decrease in correlations. For the current bear market, this would entail capital flowing back into altcoins at a rapid pace, or Bitcoin breaking loose and outperforming alts by a large margin. Correlation values trending downward should be a positive indicator that the market is maybe heading into a different cycle, namely a bull. So, crypto asset correlations to Bitcoin can provide an insight to the overall market behavior. It's true that the correlation values between crypto assets and Bitcoin have been increasing over the past years. But when using smaller timeframes, they can be useful to visualize where the capital is flowing during market cycles. From 2016 to date, similar correlation patterns are observed during bull and bear markets. Correlation analysis can also be extended to on-chain data. Payment count, difficulty, hash rate, and transaction fees are all examples of metrics that can be further analyzed. An example of an interesting on-chain observation is that Bitcoin and Ethereum currently have a very different relationship between their price and their hash rate/difficulty. As with any potential crypto asset market indicator, correlations are only a supplement to technical and fundamental analysis. Although Bitcoin has existed for a decade, many of the altcoins have only emerged recently. This leads to a small data set to study. I also like finding correlation to non-technical studies, such as Spencer Bogart's recent article, which details a survey about Bitcoin awareness and usage before and after the start of the bear market. One of the most interesting takeaways is the shift in a macro trend about Bitcoin awareness and usage, chiefly the role that millennials have to play. To help put the millennial proclivity to Bitcoin in perspective, only 37% of people under 35 are invested in the stock market. And yet, the data point is that 20% of those same group own Bitcoin, which is particularly surprising. Ultimately, what Spencer finds is that Bitcoin is a demographic megatrend. Younger demographics are leading in terms of Bitcoin awareness, familiarity, perception, conviction, propensity to purchase, and ownership rates. So using all this data and these macro trends, here's what you need to know. You need to build your portfolio to include non-correlated assets to maximize risk to return ratio. This is the holy grail of portfolio management. You need to understand the market indicators that crypto asset correlation provides. And finally, you need to see the macro trends that are moving favorably for the space and in ways that will be very different than previous cycles. Using sound portfolio techniques, proactively utilizing data, and truly seeing where the space is heading will put you in the front of the speculative crowd. At Ready Set Crypto, this is what we aim to do every day. So thank you so much for watching and for supporting the channel. If you haven't done so already, please subscribe to our channel and be sure to head over to our site where you can get on our free daily newsletter for market updates. Thanks again for watching. I'll catch you in the next one. Cheers.